Good afternoon, advisors. Welcome to the third webinar in our 2015 series this year. We are focusing this year on a family, the Greens, all 4 generations of them. And as with any family, there's drama. They're bold and beautiful. They're young and restless. We'll paint their portrait of risk and look at ways to protect the family and the family business. How will we do it? With insurance solutions tailored to meet their needs as they travel through the days of their lives. They all have just one life to live, but that life will be filled with glee at times and with passion at others. But through it all and across the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. Each month's series lasts about 50 minutes. The narrators of these hour-long series know that you'll have burning questions, and since they're performed in front of a live audience, feel free to be interactive. Type in your questions, and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, loyal fans will receive 10 CFP-CE credits, 1 for each month. The more you tune in, the more you know. Today we focus on Ben, second generation, and his wife Mary, who will be transitioning the family business to their son Carl and retiring in 10 years. We have 2 narrators today. Your first narrator is Jill MacNeil. She'll show you how they can get the best long-term care insurance protection. She'll share with you her personal stories along with Ben and Mary's journey. The other voice you'll hear is Jerry Skapyak, our annuities and hybrids guy. What will happen if Ben and Mary go on claim at the same time? Will they deplete their savings, or will a hybrid solution save the day? And now, to start today's episode, I give you Jill.
Good afternoon, everybody. Thank you for joining us today. If you have not joined us earlier this year for our past webinars, let me introduce you to the Green family. As Dina mentioned, there's 4 generations of them, and we'll work throughout the year during the different phases of their life and during their different ups and downs and financial needs. To keep the family straight, please note that anybody whose first name does not start with A, B, C, or D married into the family. If you missed last month's webinar, you missed Keith talking about Andrew endowing the Green Family Scholarship and Andrew and Julia, his late wife, setting up an islet for the protection of the family. And you can view last month's episode on demand on our website. Today we're going to concentrate on Ben and Mary. So let's learn a little bit about Ben and Mary. They are second generation Green family. They're living in Georgia. Ben is a small business owner, and his business is a C Corp. The plan is in 10 years they're going to transition the family business to his son, Carl. And this is where we come in to help him this month. Ben would like help planning for his future retirement. He's done a good job keeping his business going, but he hasn't concentrated much on his future and his retirement. And Ben and Mary have watched Ben's mother, Julia, go through a prolonged illness with Alzheimer's. So they know the impact that a long-term care event can have on the family, both financially and emotionally. So they want to plan for this. So this is the key in planning for them for the next 10 years, because they realize that failing to plan is planning to fail. When you're working with your clients and during their planning cycle, the money cycle probably looks like something like this. The first phase is the accumulation phase. And during this phase is when they build up their assets, so their working years. The next phase is the preservation phase, probably in their 50s or 60s, where they're working towards retirement and want to make sure that they have preserved enough of their assets. And then the third phase, the distribution phase. This is retirement. Now, Ben and Mary, as I said, have done a good job during the accumulation phase. But when it comes to the preservation phase, their big problem is they sank most of the money into the family business. So now that they're entering the distribution phase, this is where LLIS and you can help. In the distribution phase, they want to spend their money and hopefully have a happy retirement. But what if they have a prolonged or catastrophic illness like Ben's mom, Julia? You want their distribution to stay healthy. Because the family business is going to Carl, their son, so they won't have a big windfall at retirement from its sale. What can we do for Ben and Mary in the next 10 years to secure a comfortable and happy retirement? So during this webinar, I'm first going to talk to you about long-term care policy, some facts and figures, and show why it's not only important for Ben and Mary to consider a long-term care policy, but for your clients too. And then Jerry's going to step in and talk to you about hybrid life/long-term care policies. So let's first look at some statistics and numbers when considering long-term care and the possible real risk that this may be an event in your clients' lives. Aging population. The U.S. population is aging. In 2010, there's about 40 million people over the age of 65. It's projected that by 2050, that number will have more than doubled to 88 million. And right now, there's 2/3 of care is provided by Medicaid. So a system that is taxed now with 40 million, how's it going to handle that more than double the amount of numbers? And we've been told from advisors very often that the hardest conversation for them to start with their clients is talking about long-term care. I want you to know that on LLIS.com, we have an e-brochure called How to Talk to Your Clients About Long-Term Care. This should help you get that conversation started with your clients. Are your clients ready to live to age 95 or beyond? With advances in medicine and medical technology today, people are living longer. They may be living longer, but they may, during the later years, have an increased need for assistance. The medicine and the medical technologies help them live longer, but during these later years, they may need more assistance. So are your clients ready for that longer period of retirement? Retirement, as we know it, today may not exist much longer. People are having to work longer to provide for that longer retirement. Here's some more facts and figures that clients should be aware of. Upper middle class couple. That's probably the majority of your clients. So it's shown that upper middle class couple, age 65 today, 43% of them have a chance that one or both of them may reach at least age 95. Just think if they both reach age 95, are they have enough funds in the retirement? And if they have a long-term care event, how would that affect it? Because 63% of people who reach age 65 eventually will need some form of long-term care. That's a large majority. But the bad news is only 10% of Americans say they have saved specifically for a long-term care event. And as we're seeing, the long-term care event is a very real likelihood. So are they planning for that? Let's look at the real risk. After reaching age 65, the real risk that a man will be involved in a major house fire is only 2.2%. A woman, 2.6%. Be involved in a severe car accident. For a male, 15.5%. A woman, 18%. So not real high, but there is an incidence that could happen. But the chance that they may need long-term care after age 65, 44% for men, 72% for women. So even if it's maybe a short need for long-term care, but it could be much longer. It may be more than a fender bender. And your clients are probably have purchased coverage for homeowners insurance and auto insurance, but are they planning or providing for the need that they may need in the future, for long-term care? Because it really is a risk. Now let's look at the risk. If they have that risk, if it happens, what is the cost that it could be for them to spend some time in a nursing home? The national median price for a private room in a nursing home in 2011, it was just over $77,000. But you can see that every year it's gone up. So in 2015, the median price is $91,000. This is a 3.95 5-year annual growth rate. So as I said, this is the median price. Depending on where your client lives, the price could be higher for care in their area or it could be lower. So let's look at how that varies. So let's look at the lower price to the highest price state. Louisiana has the lowest price for a private room in a nursing home. The median price just over $62,000. So if you can't tell what that picture is, that's a poor boy. Our thought is at $62,000, they may have some money, extra money to spend on poor boys. Compared to Alaska, which is the most expensive state, with an annual price or median price of $281,000 for a private room in a nursing home. We realize not many of you are in Alaska or have clients in Alaska, but we wanted to show the difference in price and how important it is to realize what the price of care could be for your client. So we know it's hard to sell somebody Alaska ICE, but hopefully their advisors, financial advisors, are selling them long-term care policies. If you want some assistance finding out how much care is for your clients, please contact me. I'll be happy to help you with that. We know the impact on if somebody becomes sick, or the impact on care recipients or the person that's sick. We know what a big impact that is, but it's also a big impact on the caregivers. And usually the caregivers is a family member, maybe a spouse or a son or daughter. And Genworth recently did a survey to see what that impact is on caregivers. And here are some of the numbers. Found out 33% spend 30-plus hours a week on caregiving. So if this caregiver is a son or daughter and they are still working and they're spending 30-plus hours a week before or after work, that's a lot of time they're spent, a lot of time they're giving up to help provide for that family member. 66% care-related distractions at work. So if they're spending time at work, maybe spending time on the internet or spending time on the phone to find assistance for that family member or to take care of bills or doctor's appointments, that is a lot of time away from work or distractions at work. 49 is the average age of caregivers. And when I started putting this presentation together and I saw that figure, I started thinking about it. I thought, well, that's about the age I was when my dad first became sick, and I started to have to go to Canada on a fairly regular basis to help my mom take care of him. And when we were practicing this presentation with the rest of my coworkers, we started talking about these numbers, and we did a quick poll, and several other people said, yes, they were about that same age. Judith was between 50 and 55 when her father became sick, and she started having to go back to Nebraska fairly often. So a lot of times, as I said, when we're preparing these presentations, we look at these statistics and think, well, I don't know if that's accurate, but when we do a poll, we certainly find out they're pretty spot on. 60% says negative impact on their jobs. I don't think, hopefully I didn't have that big an impact on my job when I was helping take care of my dad, but it certainly can occur. And then 46% said they spent more than $5,000 each year in caregiving. Now, I don't think I spent that much, but I did spend a lot on airline tickets to go up to help take care of my dad. Now let's look at a long-term care policy for Ben and Mary, because as I said, Ben realizes the impact that a long-term care event can have because watching his mother go through the long illness. So we looked at where they live. In Georgia, the average price for a private room in a nursing home, $5,931 a month. And at LLIS, we use what we call the 80% rule. And what that means is that number of $5,931 includes the price of food and other necessities that they probably already have in their budget. But about 80% of that number is what it would cost them out of pocket for the nursing home. So we'd recommend they consider a monthly benefit of $4,700. Elimination period, generally we recommend a 90-day elimination period. Most of you advisors have told us that you recommend their clients have a 3-month emergency fund, so that 90 days would cover that. Also, take into consideration that your clients may receive some assistance with Medicare. Medicare would help pay for the first 100 days of care if your client was in a hospital for 3 days or more and released to skilled care. So that 90 days could run concurrent to that 100 days of Medicare. There are shorter elimination periods and longer. Inflation option, most companies these days offers 3, 4, 5% compound inflation. We chose 3% for Ben and Mary because it will still help grow the policy. As we saw on an earlier slide, the average increasing price for nursing homes is 3.9%. 95%. So the 3% doesn't quite keep it up there, but it does keep it growing. And at 3% compound, the price on the premium is not as high as the 5%. So it sort of keeps the premium moderate. It shows a 4-year benefit period for them. The average length of stay in a nursing home is just under 3 years. But for Ben, since he knows that he has family illness of Alzheimer's in the family, he wanted a nice long benefit period. So we added an extra year on there. And then we added the shared care rider. So with the shared care, it makes 8 years to share between them. And I'll get into that a little further down, a couple more slides. The premium for this policy, $4,955, is the combined annual premium. Now, I'm showing you this slide not so you can visualize how Ben and Mary are going to spend their retirement, but I wanted to help you visualize the pool of benefits when we're talking about long-term care, because that's really what we're concerned about. So the pool of benefits is achieved by multiplying their monthly benefit amount, which in their case is $4,700, times their benefit period, 48 months. So Ben and Mary each would have a pool of $225,600. So if they went on claim and used the full amount every month, the policy would be done in 4 years, and that's from day one. If they did not use the full amount, that would last longer. So this just helps you visualize a pool of benefits. Let's talk about shared care policies. I just want to take a minute here to show that there are different shared care policies out there, and these are the most common ones that you will see. The one on the first one here is when you add a shared care rider to their policies, it combines the policies. So Ben and Mary both have that $225,600. You add the shared care on there. They have one pool of benefits of $451,200. The next option with the other company, with another fairly common, is they each have their own pool of $225,600. And you add your shared care rider, you're adding a third pool of benefits that they each have access to. So if they go through their own pool of benefits, they can access that third pool. Time has shown that women are usually the ones that live longer and usually are the widows. I think it's the average age for a widow is 59, and the 80% of women are single at death. So a lot of times when we're talking to advisors or clients, they're concerned that the women have more care than the male. And we think the shared care policy sort of answers that, because when they're both living, they both have their pool of benefits, as we discussed earlier. But let's say that Ben predeceases Mary. Mary would have her benefits, plus she then has Ben's unused benefits. And Ben's premium drops off, and with many companies also the cost of the shared care rider drops off. So Mary has her benefits and Ben's, but only has to pay her premium. Let's change gears here a little bit and talk about tax deductions. Okay, as I said earlier, Ben's company is a C Corp. And when we're talking about long-term care premiums and tax deductions, C corporations receive the most benefits. So for the employer, the business pays the premium for the employee, the spouse, or the dependent. And the employer can be selective. He can pick and choose what employees that he wants to provide this benefit for. It doesn't have to be a certain group. He has the choice. 100% deduction on the total premium paid for the company. This deduction is not limited to that IRS age-based eligible premium table, so they can deduct the whole thing, which is so nice. And the deductible amount includes eligible premiums paid for the spouse or the dependent. So now let's look at the benefits for the employee. The entire long-term care premium paid by the business is excluded from their adjusted gross income, even if the premium exceeds that IRS table. So let's look at the benefits of this for Ben and Mary. Tax savings for Ben and Mary. So Ben's company pays the long-term care premium and he makes agreement with Carl that the company will continue paying that premium even after retirement. So they pay that premium to the insurance company. And Ben and Mary are in the 28% tax bracket. So with a premium of $4,955 times the 28%, they would have had to pay a tax of $1,384.40. But again, since it's a C Corp paying the premium, he doesn't have to pay that tax. He doesn't have to worry about that money. So with Ben, there's no money out of, since it's a C Corp paying for that pocket, zero money out of Ben's pocket to pay for the premium or for the tax. The company doesn't have to tax. Ben and Mary receive that benefit. And with Carl and Ben agreeing that the business will continue to pay the premium, it's a good succession planning tool and a good way for you advisors to stay involved. So it's a win-win situation when we're talking about tax deductions for C corporations with long-term care premiums. I'm sure you're all familiar with David Letterman, and in honor of his retirement tomorrow, we've come up with our own top 10 list. So this is Jill MacNeil's top 10 reasons to purchase a long-term care policy. Number 10, purchase a long-term care policy. Your clients can protect their assets and their personal savings. They don't have to worry about those hard-earned savings going out to pay the prices for a nursing home. Number 9, preserve the quality of life. Your clients are probably used to a good quality of life, and they've worked hard for that quality of life. And if they have a long-term care event and one of them becomes sick and the other one is the surviving spouse, they want to be able to preserve that quality of life for the surviving spouse. Number 8, care options. If they have a policy, they have a choice in where they want to receive care. They have options. They don't have to rely on Medicaid and go to a Medicaid-supplied facility that's far from their home. Number 7, they can access appropriate care. Again, they have a choice of where they receive care and who they go to receive care from, or who they receive the care from. And number 6, relieve the burden of care from loved ones. They don't have to worry about showing up on their son's or daughter's doorstep as a surprise. Number 5, can assign assets to a family, friends, or charity. Again, with this long-term care policy in force, they don't have to worry about their assets going to pay expenses. They can assign it. And number 4, access a professional during a time of crisis. Many long-term care policies provide care coordinators that can come to the home and at a time of crisis or when the event is first happening and help the family plan and help them find appropriate care or facilities for the family. Number 3, stay in the comfort of your home. Many of us choose to stay in the comfort of their home and want to have that option, and the long-term care policy would make that possible by having home health care provided. Number 2, stay with children without dependents. So even if they do end up staying with their children, it's okay because they have that policy, so the children don't have to be the care providers. The policy will pay for the home health care provider. And number 1, plan for the future. It's a bridge for the future. Having that policy in force will help them feel secure, have that peace of mind, knowing that they have that plan and you can be in part of that plan. Okay? Well, unlike Dave, I'm not retiring tomorrow, so I'll be here if you need any help with your long-term care in the future or you need any cost of care. Right now, I'm going to pass this over to Jerry, and he's going to talk to you about hybrids.
Thank you, Jill. So we're going to change gears a little bit, and we're going to talk about how hybrid life policy may be able to help them. Hybrid life policies are like the Swiss Army knife of long-term care products. They provide many different options to the client. We're able to do it with life insurance. We're able to do it with annuities. You can select different benefit periods, inflation options, payment options, riders. I often hear from advisors that when an insurance company tries to combine multiple policies together, that they're not very effective. I'm going to tell you right now up front that that is not true when we're looking at these policies. These hybrid life policies, I want you to think of them as a long-term care policy with a life insurance wrapper around them. There's very little life insurance and much, much more long-term care. So when we're looking at hybrid life policies, they allow us to use or leverage sleeping dollars. So if your clients have like a life insurance policy that has cash values and they no longer need that life insurance, we can take that money from that policy and use it to purchase a hybrid life policy. Also, if your clients are going to self-fund, so maybe they got money sitting in CDs or a money market that they've got set aside to help fund long-term care, we can use that money that is just sleeping dollars and get more benefits out of that money. When we use these dollars, like from life insurance policies, or if we're using the money from savings account, money market, CD, we're going to have that money do double duty. And when I say double duty, I mean that that money is still there. If they need it, they can still get at it, they can spend it, but it's also going to create a large long-term care pool that they're going to have access to. And these policies answer one of the top objections that we see for long-term care, that the client doesn't want to pay for something they may never use. So who are the ideal clients for these hybrid policies? Well, first, it's a client who's thinking of self-insuring for long-term care. Why pay for something dollar for dollar when you can put $1 in a policy and get 2.5 times the benefit? This client also has to be able to write a big check. How big of a check? Typically at a minimum $50,000, but to get a policy with some meaningful benefits, the premium needs to be around $100,000. They have an existing policy with cash value, so if they have that existing life insurance policy, we can have it do double duty inside of a hybrid life policy. They want guaranteed premiums. One of the, I'm sure everybody's seen written up quite a bit over the last couple of years, is that the premiums on existing long-term care policies are going up. With these hybrid life policies, once the policy is purchased, the premium cannot change. The insurance company cannot come back and ask for additional money. All the premiums are guaranteed to remain level for the period that was during the period of time that was selected when purchasing the policy. They like the idea of long-term care, but don't want to pay for something they may never use. Once again, answering that one of those most popular objected questions. They want guaranteed return of some benefits. With the hybrid life policies, if benefits are not used, there's going to be a death benefit paid to the beneficiary. If they do need benefits, the policy is going to pay the long-term care. So somebody's going to get something out of this policy. And of course, the benefits are paid tax-free out of the policy. So are hybrid benefits substandard? Are there benefits they pay not as good as traditional long-term care policies? No, they're actually equal to what you would get out of a traditional long-term care policy. They're going to provide care in all the same places a traditional long-term care policy does. They'll provide home health care, adult daycare, assisted living, and nursing home benefits. And to qualify for these policies, it's the same. Your client has to not be able to do 2 out of the 6 activities of daily living or have a cognitive impairment. And once again, all the benefits paid out of the hybrid policies are tax-free. So with the hybrid policies, hybrid life policies, we can maximize the death benefit for your client, maximize the long-term care, or maximize the cash value. We just need to know what is important to your clients when we're setting up this policy for them. We have several funding options available. We can do a level pay where that client can pay for the policy over their entire life. We can do a 1035 exchange from an existing life policy, or we can do a 10-pay or shorter. These policies, the hybrid life policies, generally work best with a 10-pay or shorter scenario. Anything over that, we start losing some of the features that we're able to get that we would see with traditional long-term care policies. There is underwriting required on these policies. Just like traditional long-term care, there is some underwriting on the hybrid life policies. We are going to be underwriting for both life insurance and long-term care, but it's not as stringent as traditional long-term care or traditional life insurance. A little bit more flexible, not a lot, but a little bit. And long-term care benefits are paid tax-free to the owner, and the death benefits are paid tax-free to the beneficiary. With the hybrid option, we have several options available. We have benefit periods anywhere from 2 to 8 years. We can even do an unlimited benefit period on one of the policies. There is inflation options, 3 and 5% compound, or we could do 3 and 5% simple. Just really need to know what is important to the client. So when we're looking at these hybrid life policies, I want you to think of them as different buckets. So in bucket number 1, we have the long-term care benefits of the policy. Anything paid out of this bucket is paid tax-free. In bucket number 2, we have the death benefit. This is going to be paid tax-free to the beneficiary. And then in bucket number 3, a lot of the policies have return of premium options that after a certain amount of time, the full premium can be returned to the client at a minimum. So let's take a look at Ben and Mary. We have 2 hybrid options for them. We can either look at an individual policy for each of them, or we can do it as a joint policy for them. So let's focus on the individual policy first. We're going to look at a $4,700 monthly benefit, the same as Jill talked about, 4-year benefit period, and 3% compound inflation. Exact same type of policy as Jill was talking about with traditional long-term care insurance. So with Ben, we're going to look at a 10-pay premium, and his premium is going to be $9,744. He's going to pay that for 10 years, and then the policy's paid up. Quite often we get asked for traditional long-term care, can we get a 10-pay premium so the policy's paid up? You can't on traditional long-term care. You have to pay that premium for the rest of your life. But with the hybrid policies, we have options on payments. So we're going to look at 10-pay premiums. So Ben's 10-pay premium is going to be that $9,744. We have the 3% inflation. Our monthly benefit is going to be the $4,700, giving him $56,400 per year, or total long-term care pool of $235,000. His death benefit is going to be $112,000, and in that first year, there is no return of premium. Fast forward to age 80, our monthly benefit has grown to $9,006. Our annual pool has grown to $108,000, and our total long-term care pool is $450,000. Our death benefit's grown to $129,000, and we have full return of premium on this policy. So if Ben decided, you know what, this has been great, I no longer need this coverage, he can surrender the policy and get all his premiums back that he paid. So let's say at age 80, Ben goes on claim, and he's going to use the full monthly benefit amount. So he's going to use $108,072 a year for long-term care benefits. That amount's going to be subtracted dollar for dollar from our long-term care pool, our death benefit, and our return of premium. So at the end of age 80, our long-term care pool has been reduced to around $342,000. Our death benefit's been reduced to $21,000. And since we've already withdrawn out more than what we had paid into the policy for the premium, our return of premium is going to be 0. So Ben really cannot surrender the policy at this point anymore. Not that he would want to, but it's not really an option. So we go to age 81. Because of our 3% compound inflation, our monthly benefit has increased, so has our annual amount we can take out, and our long-term care pool. Once again, Ben's going to use the full amount. That's going to be subtracted dollar for dollar from our long-term care pool and our death benefit, leaving us with our long-term care pool available of $222,000, and our death benefits reduced to 0. But with this policy, they have what's referred to as a residual death benefit, which means he's going to have, or his beneficiaries are going to get $5,640 no matter when Ben passes away and no matter how much of the long-term care benefit he uses. Now, if we switch over and look at Mary, her 10 premium is going to be $9,664. Same monthly benefit, same long-term care pool. Death benefit's a little bit different. We fast forward to age 80. Same monthly benefit, $9,006 at that point. Our same amount for our long-term care pool. Death benefit's a little bit different because she is a female, and her return of premiums is different because she's paid in a different amount. So we looked at the benefit individual policies for Ben and Mary. They're each going to have a $4,700 monthly benefit, 4-year benefit period, 3% compound inflation, and together they're going to pay $19,408 over those 10 years, or each year for 10 years. Changing gears, looking at a joint policy now. So we're going to look at the same amount of $4,700 monthly benefit. This policy has a base amount that is base benefit period, which is 50 months. It's basically 2% of the death benefit. What we're able to do on the joint policy is we can add a rider on it. The rider gives us two choices. We can either do a lifetime benefit rider, or we can do a 50-month extension rider. And we can add inflation on this policy, but it is only available on the rider. So what we're going to do is we're going to look at a 50-month extension rider and 3% compound inflation. So we're going to go back and we're going to look at our buckets. And if you haven't been paying attention, I encourage you to pay attention, because this policy, this joint policy, solves a lot of the questions we get asked from clients or from advisors. We're often asked, can we get a long elimination period, longer than 1 year? Well, the states are the ones that that set the maximums for elimination periods. But with these hybrid life policies, your client's using their own money first, so therefore it's giving them that long elimination period, and we can really see how that works with this policy. So Ben and Mary, their 10-pay premium is going to be $14,107. They're each going to have $4,700 a month available to them, meaning they each have $56,400 annual available for long-term care, and their long-term care pool is $235,000, and that's on the base policy. Then we have the rider. So at age 58, the rider has the exact same benefits as the base policy. Fast forward to, or I guess combined at age 58, their long-term care pool is $470,000. Their death benefit's $235,000, and they have a little bit of return of premium because they've only made one premium payment. We fast forward to age 80. Our base policy is still exactly the same. Only thing that's changed is we have our return of premium has grown a bit. It is more than the 10-pay premium that we put in, because it does have a cash value in this policy and it is growing. But our long-term care benefits are exactly the same as they were at age 58. But our rider, it's growing at that 3% compound inflation. So our monthly benefit has grown to $87.43. And the long-term care pool for that rider has grown to $437, meaning that at the end of age 81, our long-term care pool has grown to $672,000. So Ben and Mary both go on claim at the same time, and they are both going to use the full monthly benefit. So remember, I was saying, advisors are often looking for long elimination periods on long-term care policies that are not available, but we can get it with this policy. So Ben and Mary are going to go on claim. So they've paid in roughly $140,000 into this policy. So they're going to go on claim, and they're going to use the full monthly benefit. So basically, they're each going to use the $4,700 a month, or $56,000 a year. So for a total, you're going to use $112,800 a year. And that's going to be subtracted dollar for dollar from that long-term care pool for the base policy, the death benefit, and the return of premium. So at the end of age 80, Their long-term care pool on the base policy has been reduced to $122,000. Their death benefits reduced to $122,000, and the return of premium has been reduced to $46,000. So at this point, if they decided they didn't want the policy anymore and they wanted to surrender it, they'd get the $46,000. Not that they would want to. The rider continues to grow. It's earning that 3% compound inflation. So at the end of age 80, our total long-term care pool is $559,000. We go to age 81. Our base policy has not changed the amount that it's going to pay for long-term care. If your clients were going to be funding long-term care themselves, they're going to be writing it all out of their pocket. But this policy is going to stay the same. Yes, they are going to have to pay for some out of their pocket. At age 81, $4,700 is not going to cover all the long-term care costs, but it's going to help. Once again, we're going to subtract dollar for dollar from the different buckets, the $112,800. So what we're left with at the end of age 81, our long-term care pool on the base policy is $9,400. The death benefit has been reduced to $9,400. And since we've withdrawn more than the account value of the life policy, there is no longer a return of premium available. The rider on the policy continues to grow. So at the end of age 81, it's now up to $9,006 a monthly benefit. So at the end of age 81, our total long-term care pool is just about $460,000. So your client has put in roughly $140,000 into the policy and has received so far about $124,000 or $224,000 of long-term care benefits. Age 82, that base policy is going to, in a sense, pay for the first month for each of them. So they're going to get the $9,400 out of it. So at the end of that first month, there is absolutely nothing left of that base policy. The rider is now going to kick in. So where they were receiving $4,700 a month, now they're going to start receiving the $9,276. You wanted a long elimination period? You got it. Yes, they got a little bit of long-term care benefits out of it, but now that they've had, just a little over 2 years of benefits paid for with the base policy, they paid $140,000. They paid some out of pocket. Also, not as much as if they didn't have the policy, but they had that long elimination period they were looking for. And now the rider part of this policy, that's going to be more of a full long-term care benefit, is going to kick in and start paying. So they're going to continue with their claim, and they're each going to start receiving the $9,276 a month, or for a total of $204,000. At the end of age 82, that long-term care pool on that rider has been reduced to $259,000. We go to age 83, there is nothing left of that base policy. Our rider continues to grow. It's now up to $9,554 a month. They use the full amount again for that whole year, receiving $229,000 in benefits. And they're left with $38,000 of benefits left. Now remember, with this policy, if you're looking for that catastrophic long-term care policy, we could have added on lifetime benefits on this policy, and it would continue to grow at that 3% and continue to pay as long as one of them is alive and they need the long-term care benefits. But we wanted to keep all these examples as similar as possible looking at them. So we looked at Ben and Mary. They had a joint policy paying them $4,700 a month for the first 50 months. The total benefit period on the policy was 100 months, 50 months of a base policy, 50 months for the rider. We had 3% inflation on that rider. Their 10-pay premium was $14,107 combined. So when we look at the three different options we talked about, we tried to kind of compare them for you. So the monthly benefit was exactly the same on all three policies. The length of benefit period was about the same. The long-term care had 8 years with shared care. We had 2 individual hybrid life policies, 4 years each, for a total of 8 between them. And the joint hybrid life equates to about 8.33 years. The elimination periods, the traditional long-term care and the joint hybrid both have 90 days. The individual hybrid life has a 0-day elimination period. Death benefits. Traditional long-term care does not offer it. On the individual hybrid life policies, the death benefits was $129,000 for Ben and $137,000 for Mary, but the survivorship policy was $235,000, and that is a second to die. So if they never need long-term care, and once the second person passes away, the $235,000 would be paid to the beneficiary. Compound inflation. We have 3% on both the individual long-term care and the individual hybrid life, and then we have 3% compound inflation on the rider only. Fortunately, we can't get it on the base policy. Total premiums paid to age 80. With the traditional long-term care, we would have paid $109,000. Our individual hybrid life policies, we would have paid $194,000, and on our joint hybrid life, we paid $141,000. Actual benefits received is exactly the same between the individual long-term care policy and our hybrid life policy. Our joint policy pays out a little bit less because our base policy did not have the inflation protection on it. Premium tax deductibility. With our traditional long-term care, we are able to deduct the premiums that are paid. The hybrid policies, we cannot deduct those premiums because they are technically classified as life insurance. And return of premium or surrender value. Well, with traditional long-term care, there is no cash value in the policy, so there is no surrender value or return of premium offered. In the individual hybrid life policies, we have full return of premium. And in our joint hybrid life policy, we have return of premium, actually a little bit more because it grows. So, to summarize it, if you're looking for the absolute lowest cost to provide long-term care, nothing is less expensive than a traditional long-term care policy. If you're looking for a policy with the most flexibility, it is an individual hybrid life policy. This policy, like I said, it's like it's a long-term care policy with a life insurance wrapper around it. It is more expensive, but we're going to guarantee that somebody's going to receive some type of benefit out of it. And the joint hybrid life policy, it's a hybrid policy, and it works just like the shared care did on the individual hybrid or the individual long-term care policy. So we talked today about long-term care insurance and hybrid life policies. So the traditional long-term care policies are like a knife. They're designed to do one thing, just like the Ginsu knife. And there's more. The hybrid life policies are the Swiss Army of products. They provide multiple things that we can do with them. Now, we'd like you to turn in next week to find out, will Andrew help Barbara fund her retirement and care as she ages? Or will her daughter Claire have to come back to work and her 3 grandkids quit school to become caregivers? And did you know that Mark is going to be presenting a webinar for the XYPN members on June 3rd? And you should get a Policy Matters in your email inbox tomorrow. This quarter's focus is on disability insurance. Next month, our webinar is going to be on You Can Keep Your Clients from Running Out of Money, and you get to hear Jill and I talk again. Going on with the 10 things that make LLIS different. For those of you who have not worked with us, we're not your competition. We only work with fee-only financial advisors. When you refer a client to us, the only thing we talk to them about is what you ask them to purchase. We do a lot of pre-underwriting to help minimize those surprises in the underwriting process. And if you haven't checked out our website, I encourage you to do that. We have special sections for advisors and clients, and we have tools out there for each. We are proud sponsors for these different organizations. And we have product specialists in both life and disability, long-term care, annuities, and hybrids. And when you have your clients apply for life insurance with us, and we get so many positive comments on this, we have our AIM system, application information message. What this is, it's an automatic email that is sent out to you and the client, and it outlines the steps that they will be going through in that underwriting process. But it does much more than that. As each step is completed, both of you are notified, and it lets you know what the next step is, and each step will give you approximately how long it will take to complete that step on average. And once your clients purchase the policy, we don't go away. We help manage your clients' policies both now and in the future. Our advanced premium emails, we will send you an email, you and your client, about a month before the premium is due. It is amazing how many clients move and never notify an insurance company. It has greatly cut down on the number of lapse policies that we've seen. We are also going to keep track of the conversion options on your clients' term policies. We're going to let you know about 6 months in advance that conversion option is coming up. May be important, may not, but if your clients had a serious change in health, you may be happy that we're notifying you that so we can take care of that. We're also going to let you know when those term policies are going to be expiring. We just need to know, does your client still need insurance? If so, we need to start that process sooner rather than later and getting them new coverage in place before their existing policy is going to expire. Well, that's everything we have for you today. Is there any questions? Please input them on the screen, and Jill and I will be happy to answer them for you. We'll give it a minute to see if anybody's going to input any. Well, I am not seeing any, so thank you for tuning in. If you do have any questions later on, mine and Jill's email address is up there. Please feel free to email us, and we'll be happy to answer any questions you have. Thank you.